Hello, all. Today is Thursday, June 3rd, and I'm back with another Trade Journal walkthrough. So, first up here is CVS. I entered the trade here at this little icon and I exited here. And because I trade options, I'm now also marking my strike price. So, my strike price in this case was 87. So, I placed a call saying that CVS will reach $87 by tomorrow's date. So I entered on this candle here. And, one of the things I was talking about yesterday is I said something like you don't enter on a two. It isn't that you don't enter on a two, it's that a two isn't an actionable signal. So in this case, you're looking at what is a known fact, which is if you have an inside candle, the buyers and sellers are in equilibrium, and then you trade on that next candle as soon as it breaks to either side. So that's what I did here. So we had a two down, we had an inside candle, and then we had a two up, and I entered the trade as soon as this hit two up. So that would have been right here at around 86.14. This trade represented a 52% gain. So that's pretty good. So if we use this measuring feature right here, if we go from this candle to the candle that I exited at, it looks like that gained 51 cents and across 7 bars for a 0.59% gain. And of course, I'm doing options, so that is actually a 52% gain. So let's see what else. So there isn't much else to say on this trade in terms of, I didn't have to make many decisions throughout. It was two ups all the way. So in that regard, it was pretty easy to know that, I was going to be in profit because each time I moved my stop up. So I entered on this candle right down here. So then I made my stop at the top of this candle, top of this candle, top of this candle, and worked my way up. We can talk about what I was thinking when I exited, though. So I exited here on this two down, and again, same idea as the reversal that I entered on. So I entered on a bullish 212 reversal, and I exited on a bearish 212 reversal, meaning we had a two up, an inside candle, and then a two down. So I exited right here. Not exactly, but this is the point at which I look to exit. So I started competitively placing my options contract to sell. So I exited on this candle, and just to see how it did throughout the day, it went on to. It did get a little higher much later in the day, though, so it traded sideways for a bit. So that was a good trade. Next up is XLF. So in this case, I entered here on a 222 bullish continuation. We had a 2-2 reversal down here, and then I entered on this candle. And ultimately, it did immediately go two down, but I wasn't too worried about holding on to it because, as you can see here, there was some pretty strong price rejection to those lower prices, and the buyers were in control. So even though it went two down and below the previous candle, it ultimately ended green, meaning buyers in control, and rejected that price. There were some kind of trials along the way, though, to see if I should hold. So after that two up, we had an inside candle, a two down, but again, compared to the two ups, this two down was pretty weak, and it was a mini hammer in this case, meaning we had an inside candle, we went two down. So typically a 2-1-2, that would be a bearish reversal. You have a two up, inside candle, and two down. But you can see here that you can tell the one was a doji, which means buyers and sellers, no one had control here. Still waiting to see who had control. And then the seller's attempt for control was rejected. So in this case, sellers had control, but they weren't able to hold that lower price. And I was already in profit because I entered on this candle. I moved my stop up. So there was no need to get out at this point. And then we had another strong two up. We had some more sideways inside candle action. and then we went another strong 2 up, and this is where I ultimately got out. So you can see here it was 2 up, but the sellers were in control, so it closed here. Then we had a doji, opened and closed at the same price with the sellers in control, but barely. And then I decided to get out here because it gapped down on the open. So it opened here and it closed down here, and I immediately got out as soon as I saw that gap down. And it did end up going up after that, but then, it shot down after that. So in terms of where I got out, could have made a little more profit, but happy with where I got out and looking at what price action was doing at that point. And that was a 28% gain from here to here. And my strike price was actually $38.50. So it exceeded what my strike price was. So that shows you, the price, the premium that you buy your options contract at plays a lot into what your gain is going to be. It's not just your strike, because we exceeded that strike. I sold around 38. I sold above 38.50. So whether that was 38.53 or it was about 38.53. But the point is that doesn't automatically equal a home run play just because I reached my strike. I clearly bought this at a higher premium, but I bought it off of reading the price action to know we were going to go up. So that options contract was going to go up. Okay, next up is T. So this is AT&T, and I actually bought a put, not a call against this. In this case, my put strike was 29. So that is pretty far away, as you can see here. But from my orb strategy, this was trading pretty tight. And from a contract perspective, this was the closest put that I could buy. So I bought 29. And the thing to remember when you're trading really tight and those strike prices are far away, you run the risk if this thing reverses on you to lose, your entire value of your options contract pretty quickly, or like 50% of what you paid. So I went in low on this one, and I do that often just to get, quick wins. So here, I got in on the 2-2 reversal. So let's zoom in on these candles a bit to see what was going on. So there was a 2 up, 2 down, very clear reversal here. So I got in on this candle at around here. And you can see my alert is still there. I don't know why, because it would have gone off, but maybe I set another one after as my initial stop loss. So I got in here, and then it's pretty smooth sailing. I watched this go 2 down, 2 down. I watched 2 inside candles form. I was still comfortable because I was already in profit. But ultimately, it did go 2 down, 2 down. And let's take a look at where I got out. So I got out on this candle, which is a doji. In this case, open and close at the same price. It looks like this is a 2-1-2 reversal to the upside. And I actually got out when it would have been showing a little thicker. So I didn't wait until it closed, meaning it wasn't a doji when I got out. So to me, this would have looked like, a very solid 2-1-2 reversal. And it did go up a bit. It did ultimately fall again. But yeah, that is the candle I got out on. And I'll say that was probably around 29.31. So that's the other thing I'm looking at. If it's crossing this line of support, in this case, I get this line from my opening range breakout strategy, which takes the high and low of the first 30 minutes of trading and then charts 2 targets to the upside and downside. So this is the first target to the downside. So the fact that it was crossing that again or nearing crossing that again, it looks like it didn't actually cross. Like that was enough for me to say, okay, 2-1-2 plus that, I'm out. And that was a 16% gain. And finally, NEO. This was my loss for the day. So I got in here on this one candle. And for me, I was doing a play to get in early. Because if I knew if this was going to go 2 up, it would have to cross the top of this one. So I got in towards the end of this one candle. It opened here and it closed here. So I got in around here with a very tight stop, automatic type stop back here. And I knew if it went 2 up, I would keep it. So in this case, I did not get stopped out because I canceled my automatic stop before it went down, and it went 2 up first. So it went 2 up, it went 2 up again. I was in profit here. I don't remember what percentage, but I was in profit. And then it did a 3. I held on to it because I wanted to see if it was going to go 2 down after the 3, an inside candle, or 2 up, and it ended up going 2 down. So I got out on this candle. So I entered here, I exited here, and I lost about, I don't remember, I think it was around 3 to 5% on this one. Obviously, I'm a little more eager to chart my gains, but I just moved on from that one, so I didn't actually put what my loss was, but it was around 3 to 5%. And in this case, my strike price was 42.50, so that's what I was aiming for. And a good time to get out because it kept falling, so that could have been my whole options contract. So that's the importance of tight stops, and if you're going to watch your trade live, reading price action and what's happening. So thank you all for watching. I haven't decided if I'm going to trade tomorrow. I might not, but either way, I am working on a beginner strat series. I talked about this in some previous videos. I planned to release it earlier, but life, other things I wanted to do. So I am looking to release it in the next 1 to 2 weeks, and it's a series that's going to start you off from the very, very beginning. So learning about candlesticks, how to read candlesticks, and then how to read candlesticks from a strat perspective, broadening formations, entries, exits, all of this. The first video itself will just be about candlesticks, though. So I'm breaking it down, for beginners. So if you're watching this and you don't quite understand what I'm saying yet, those videos will be for you. So thank you all for watching. Like, subscribe, and I'll see you tomorrow.